Really will depend upon our growth profile in the United States. I mean, our baseline going into the year was we were going to throttle down from roughly 2.5, closer to 3, down to roughly 2. There was some tariff drag that we had priced in. That's tracking to date. Where I think the market is starting to entertain is it could be a little bit worse than that. The data has clearly been soft in January, although it can be volatile. I think it's the uncertainty tax, I would call it. It's really spiked. But it has to persist at these levels. It could be from Doge. It could be from other policy headlines. The tariffs, as we've seen, there's been volatility in what the rate actually will be. And so if that sticks, this uncertainty tax will start to crimp business investment, regardless of what the tariff level itself is.
We've been reporting this morning on JP Morgan and Goldman Sachs models pointing to an increased risk of recession in the US. How do you think about that at the moment? What is the risk in your view?
Well, it's still fairly low. We would need to, but it would be rising off a very low rate. Again, I think all of us are looking at the same measures, and that's the uncertainty measure, because that'll crimp. If you're a CFO planning business investment, if you're a consumer thinking about a big purchase, it's a fairly intuitive drag, but it's got to be persistent. If we're talking about these same issues in the second quarter at a higher level, then we're talking about 1% GDP growth or lower. And once we're talking in that threshold, recession is on the table because of the volatility in the data. And we're talking about job payrolls. If you're in that world, payrolls are start to go negative.
Yeah.
And so clearly at that point, Fed's in an easing mode, regardless of where the CPI is.
Yeah, well, let's talk about the Trump tax cuts, because that's something that can definitely go into maybe even the third quarter or the fourth quarter of this year. Do you think that he's going to get enough tariff revenue in order to fund these tax cuts?
I don't think there will be a full offset. And so, again, I think there's trying to attack this from different angles, obviously from the spending side. Tariff revenues won't get you all the way, nowhere near it. And so I think you'll have some offsets. But, again, that's another pressure on the structural deficit. And again, this has been a 10-year journey, but we assume in our baseline that they get extended. But the wild card between now and then is going to be the constellation of uncertainty that's coming from the policy discussions.
What are you most worried about from here on in? I mean, when you think about there's just so much to be concerned about. I wonder when when you're falling asleep at night, I wonder which thing worries you most when it comes to the outlook for the US economy.
I worry about a downdraft in growth, not just from the uncertainty, but again, our theme was that we're going to have unraveling a little bit of this U.S. exceptionalism because a lot of the positive supply stuff we had last year, immigration has really slowed. Some of that was obviously intentional from policy, but I worry about demand holding up given these constellation of forces. The stock market has not assumed any of these dynamics, and so there's clearly downside risk for the U.S. stock market.
My other question is, looking forward, how do you think geopolitics plays into all of this?
Well, I think, even if I had not seen what had happened so far this year, I would have said to your question, Valerie, that we have, which I think many appreciate, a clear tension between two of the largest economies of the world, and that's secular, and it's not going to change overnight. And whether you think of through the lens of AI or you think through the geopolitics we're seeing in Europe, I don't think that changes the calculus or that diagnosis. I think what the new vector is Europe responding to these dynamics where, in some regards, Europe has been almost, I think this would be unfair, but somewhat forgotten about, right? And so I think you've seen a more prominent Europe, and I think that bears noting, and I think we're seeing that imprint in the financial markets today.
I want to talk a little bit about your upcoming book as well, about how AI and other mega trends will shape investments in the future too. I wonder, when it comes to putting something like this together, how do you put a pin in the AI story as to where we are now, given that it is moving so quickly? It is moving so quickly, although adoption is nowhere near the level where it's actually changing people's work day to day outside one or two fields. So I would say for the average, for average listener, if you think of the internet and the personal computer in the 1990s, we're in the year roughly 1992, maybe 1993. The growth outlook is really going to have an impact 3 or 4 years from now. We're seeing the build out of AI investment. That's kind of like computer server systems in 1994, 95. The real thrust is when you and I and everyone else is using AI as second nature. That's not what I would call consumption. And so we're early in the story. Now, the U.S. stock market is probably in the year 1998.
gotten too far ahead of itself, and that's why it's overvalued, even though we're fairly constructive on AI for the next 5 years.
Sorry, when you say early 90s, 92, 93, 94, you're talking about the beginning of the boom in productivity, right?
Yeah, and our systems, and underneath the book is we've actually quantified these relative to structural deficits, globalization, aging of society. It's all part of the same system, along with the Federal Reserve and everything else in the stock market. And it's been eye-opening what it says. And it says that it gives you where technology is, and it calibrates it to every technology past 150 years. And so it's opened my eyes, and it says that the big J curve and productivity lift is probably not coming for the next 2 or 3 years. It tells you what the optimal investment strategy is in this future world, and it's not overweighting tech stocks. But it says from the risk to growth is not today, but 3 years out, the upside risk to growth is on, for the U.S. and for parts of Europe, is on the upside. The risk is not inflation, unless AI stalls. And we give the probabilities to the readers of what that would be and the markers along the way to know, because we're talking about 3 or 5 years out in the future. AI is not, it's probably going to be more transformative in the personal computer, but we're early in the so-called J curve, so it's not a foregone conclusion.
How does China play into that? Because I guess all the attention has been on DeepSeek and the fact that these AI companies in China still have this big earnings growth where U.S. earnings growth is stalled. So.
Well, from our Megatrends dashboard, the U.S. and China are so far front of everyone else from AI investment and capabilities. There's not a close third. That means the future economic world order will unlikely change in any time in the near future. And the history of investing with technological change is very clear. It says I should overweight the value part of the universe as other companies outside of tech absorb this technology and become more efficient. And it says the DeepSeeks of the world, we're probably going to see another, if history's any guide, we'll see another 50 announcements along that dimension that drive prices down, that are new entrants. We've had 5,000 new AI companies funding in the United States alone the past 4 years. 5,000.